Welcome. This is Christopher Russell, Principal of Energy Pathfinder Management Consulting. The live version of this presentation, Energy Efficiency's Role in Business Investment, was given on Wednesday, July 27, 2011, at the American Council for an Energy Efficient Economy's Industrial Summer Study in Niagara Falls, New York. This presentation is derived from my experience as an energy manager, author, consultant, and business coach. The objective is quite simple. I want to suggest ways to demonstrate the investment value of energy efficiency improvements. This is intended for decision makers in industrial, commercial, and institutional settings. The value of energy efficiency can be proven, but with what methodology and for what audience? The facility manager, the project engineer, the machine operator, or the corporate officer. Not only do these individuals vary widely in their perception of energy, they have different ways of calculating value. The industrial sector is notoriously risk-averse and resistant to change. That's the way we've always done it, is the traditional rebuttal to the changes that energy efficiency implies. Coincidentally, it is also a rebuttal to the suggestion that we use anything more than simple payback to evaluate energy improvements. I'll suggest this to energy efficiency proponents. If you keep pushing the same buttons, you'll keep getting the same results. Let's examine the utility of simple payback with this example. Here we have a proposed energy efficiency improvement that costs $1 million to implement. This improvement provides annual energy savings of $250,000. Of course, the cost and savings figures indicate a 4-year simple payback. Meanwhile, the new asset has a 10-year economic life. However, investment decisions in this facility must adhere to a 2-year payback criterion. The likely investment decision is to reject this proposal. Investors need to know the following. How does this investment proposal compare to other investment alternatives? How will this investment improve the overall rate of return that the firm currently achieves? What's the cost of the investment, but also what's the cost of rejecting the proposed investment? Does simple payback answer these questions? The answer is no. Simple payback ignores any value that accrues after the investment has paid for itself. Payback fails to indicate the cost of capital, the investment rate of return over time, or in comparison to other investment alternatives. In addition, it says nothing about the value lost when refusing the proposed energy improvement. By comparison, do you know anyone who evaluates mutual funds, like those in a 401k program, by using simple payback? Rates of return are the common yardstick for measuring all investment types. That includes capital expenditures, or CapEx, invested in fixed assets. It includes securities such as stocks, bonds, and mutual funds. At the same time, rates of return are a benchmark for the cost of acquiring capital. Let's go back to our example with a $1 million energy efficiency proposal. We need to dig a little deeper to create a meaningful investment performance evaluation. In addition to energy savings, this project has depreciation and tax consequences. In the U.S., most energy-consuming assets are treated as 39-year assets for depreciation purposes. But as in this case, the investment has a 10-year economic life. That means that there will be a surplus book value after 10 years, a fact that we will revisit in a moment. Note the 35% marginal tax rate on income. Next is the subject of capital recovery, or the measure of how hard the firm's existing assets work in creating wealth. That's indicated by the 8.7% weighted average cost of capital, which we'll also examine in a moment. Weighted average cost of capital is the benchmark rate of return by which incremental business investments should be measured. Notice also that third-party financing of this proposal is offered, requiring a 20% down payment, a 7-year term, and a 5% annual percentage rate. To stay competitive, firms in this industry need to sustain a 10% annual growth rate. Finally, we show the rate of the return for the best available non-business investment, in this case, an S&P 500 index mutual fund. The rates of return used to evaluate investment performance are ratio measures. Value is the measure of benefits relative to an investment amount. For lenders, the ratio describes interest received relative to a lent amount. For investors, value is new cash flow generated relative to a committed investment. The investment performance of an energy efficiency investment is the after-tax cash flow expressed as a percentage of the enabling investment. If we are approaching energy efficiency improvements as investments, let's be clear about investment goals. We're assuming that investors want to grow their business. The business currently produces a rate of return from the capital already invested in it. We describe this rate of return using the weighted average cost of capital. More on that in a moment, but for now, think of that rate of return as the velocity of capital currently invested in the firm. Given the business's current performance measure, it's imperative for a growth-oriented business to seek incremental investment assets that will improve the business's overall rate of return. This is true for energy improvements or any other CapEx proposal. CapEx proposal evaluation is in 2 steps. This is important. Many people make no distinction between the terms economic and financial analysis. Let's clarify that difference in the context of business investment. Economic analysis seeks the measure by which an investment improves the firm's current rate of capital recovery. Financial analysis examines the terms for third-party finance. A good economic proposal can still be bad if the terms of finance are not beneficial.